If you've spent any time online lately, I'm sure you've seen them. Those videos with the scary thumbnails and the dire warnings. An economic crash is imminent, the housing market is about to collapse, the banks are in crisis. They go viral, they get a ton of views, and, they can be pretty unsettling. So today, we're going to dig in and figure out what's really going on. You see this word everywhere, don't you? Collapse. It's dramatic, it's attention-grabbing. Channels like Tousi TV, for example, use this kind of language all the time to predict what's next for the economy. And let's be honest, that kind of talk creates a lot of anxiety for regular people who are just trying to understand their finances. So here's our mission today. Let's try to put all that emotion and fear to one side for a minute. We're going to do a clear-eyed fact check on some of these huge claims. Our goal is to separate the fear-mongering from the actual facts and see what the verifiable data is really telling us. All right, let's start with one of the biggest fears out there, the housing market. You hear this argument all the time, that because interest rates are rising, we're about to see this massive wave of foreclosures, basically a repeat of the 2008 disaster. It's a really scary thought for sure. But is it actually happening? So, is there any hard data showing a huge spike in people not being able to pay their mortgages? Are we actually seeing the numbers go up and up? Let's take a look at the evidence. Okay, this chart from the Mortgage Bankers Association, it basically tells the whole story. Look at the bar for the 2008 crisis. The delinquency rate was way up there, around 8%. Now, look at the pre-pandemic norm. That was much lower, closer to 3.5%. So, where are we right now? We're also right around 3.5%. The difference between now and the crisis is just massive. So here's the crucial point. While, yes, delinquency rates have ticked up a little from those historic lows we saw during the pandemic, they are simply returning to where they were before 2020. They're just getting back to normal. They aren't even in the same ballpark as the crisis levels of 2008. The data just doesn't back up this idea of a giant foreclosure wave that's happening right now. Okay, so the housing market seems to be on much more solid ground than the headlines suggest. But what about that other huge fear you see online all the time? The idea that the US dollar is about to collapse and lose its spot as the world's reserve currency. The theory goes that its value is about to just fall off a cliff. Now, to check this claim, we need to know one key term, the DXY. That's the US dollar index. Just think of it like a scoreboard for the dollar. It measures its strength against a bunch of other major world currencies, like the euro and the Japanese yen. It's simple. A higher DXY means a stronger dollar. So let's think about this. If the dollar were truly collapsing, really falling apart, that DXY scoreboard should be in an absolute nosedive, right? Is that what the data is actually showing us? And the answer is a clear no. When you look at the data over the last year, the DXY is not plummeting. In fact, it's shown some serious resilience. It's held its ground and has even gotten stronger at times. That whole collapse narrative just isn't being reflected in the actual numbers. So why? Why is it so resilient? Well, there are a few pretty powerful reasons. First off, the Federal Reserve's higher interest rates actually attract foreign investment, which boosts demand for the dollar. Second, when things get shaky in other parts of the world, investors tend to run to the US dollar as a safe place to park their money. That demand helps prop up its value. These are some really big forces working against a collapse. So we've looked at the real data on foreclosures and the dollar, and it looks like there's a pretty big gap between the viral story and the actual numbers. And that brings us to the most important part of all of this. What do we do with this information? How should we think about our own financial decisions? This quote from our source material really just hits the nail on the head. The biggest danger of all this fear-based content is that it can push us into making emotional, super reactive decisions. Panic selling your investments during a downturn just because a scary video told you to, that's how people turn temporary dips into permanent, unrecoverable losses. And this is the key distinction, right here. Panic is an emotional reaction. Preparation is a logical one. This isn't about pretending there aren't any problems. Of course not. There are absolutely valid concerns out there about things like inflation and government debt, but preparation means you address those risks calmly with a strategy instead of just selling everything because of a scary headline. So what's the takeaway for you? Well, first, always question those sensationalist claims you see online. Second, try to find the real primary data sources, like the Federal Reserve or the Mortgage Bankers Association we use today. Third, learn to see the difference between a normal market shift and a true systemic collapse. And finally, it's okay to acknowledge the real risks out there, but you have to refuse to give in to the panic.
And this kind of leaves us with one final thought. We are all just flooded with information, with opinions, with predictions every single day. The most valuable skill we can have in this environment isn't knowing everything. It's having a reliable filter to sort through it all. So the question for you is, what's your strategy for telling the valuable signal from all the distracting noise?